Today, what is today all about, really? So I really wanted to concentrate on obviously the market cycle in understanding insurance and the market cycle that goes through. The reason that I wanted to utilize this topic for this month's webinar is because I think we're in a really challenging but also a really unique place. It's where we're sort of used to the market cycle being blanket, property and casualty, soft market now, prices low, etc. I'm finding that insurers are not really using that approach anymore. And I think, well, I think, I know that the reason that behind that is because insurers have so much data. Just think about the world that we live in today. And the introduction, I say the introduction, it's been a while, been around for quite a while now, but the utilization is probably the better word of AI and the use of AI. And how can insurers and how are insurers really using AI to really help be selective in the risks which they uh, say, yes, we are happy to negotiate, or ones that they're not. But I think the reason that I wanted to select this one is because it's rather unique now. And what we need to try and do as brokers is to try and get ahead of that data entry curve. But also, what data do we put in? Because that's the first thing which will hit an underwriter. And even to the extent of um, even to the extent of that the algorithm and the AI system that insurers use, that's the first thing that it sees. An underwriter really only sees it when we get in contact with them. So that's kind of what I want to explore today. And how do we get ahead of that curve? How can we ensure that the data that we put in is accurate? But more importantly, how can we be better than data? Because we're humans, right? And insurance has been around for, God, hundreds of years, 1300s or so, where we kind of see the first branch of modern marine insurance. So it is an industry which is traded by people, and it's one that runs on people. But I think are we at a tipping edge? I'm not sure. I think time will tell, I guess. Um, but how can we ensure that we stay relevant, first of all? And how can we utilize and how can we take advantage of what it means to be a human in today's soft market? Because the approach is not the same as what we're kind of used to. So I'm seeing some familiar names on from the last session. So hello again and welcome, and thank you ever so much for joining. For those who are new here, and this is maybe your first webinar, my name is Matt Owen James. I'm a training consultant. I run my own training consultancy business. I support those within the insurance industry with helping build their knowledge, helping build their confidence. I've been through three market cycles within my 18 years experience of the insurance industry, or within the insurance industry, I should say. And I've spent the last 10 years in an L&D capacity. I'm a qualified member of the Chartered Institute of Insurers, and I sort of teach that as well in terms of supporting others getting through their qualifications too. So if you do have any questions as we move through, please, please, please interact. Don't sit there and kind of be, what does that actually mean in real life if it doesn't make sense for you? I will try my best to keep things in layman's terms, because I think that's the easiest way. So if you do have any questions, please pop them into the Q&A function that should be available for you on the toolbar of the top of your Teams window. I'm sure that you're used to using Teams in today's format, but if you use another platform like Zoom regularly, maybe Teams is not so familiar with you. So yes, please ensure that you pop those questions in. I'll be answering Q&A at the end. So anytime that it pops into your head, please just ask the question, pop it in, and I will come to them at the end. But I'll keep an eye on if there's something really, really relevant, then I may pick it out because especially if we're talking about a particular topic. Timings today, as you probably know, we'll be finishing at around 1:15. And well, hopefully 1:10, and then I'll allow 5 minutes for Q&A and wrap up. But likewise, it depends, I guess, on how many questions that you have. So, not to not ask them, of course not. Please continue to do that. So, in terms of today's objectives, three key learning objectives that you can sort of make sure that we take away so that you're able to use the time to record your CPD. First thing is to define what the soft market is and to help us identify why insurers are now being selectively competitive. As I've mentioned about data, as I've mentioned about AI systems, what are insurers actually now doing? How are they utilizing all of this technology, information in order to go, yeah, that is a risk which I actually want versus, we'll quote, but is it really something in our appetite? Maybe not. Second thing I want us to be able to walk away with is to understand what can be used to help negotiations on insurance terms. Um, Again, it's the human interaction, but it's more than just what that data inputs. There's only so many things that an underwriter is able to physically see, regardless of all the systems and platforms and AI facilities that they have. There are only so many things which that is able to pull and to bring to an underwriter. So I want us to be able to know where we actually step in, both at Protect Commercial and you guys as well, dealing with this. How can we stand apart from the competition to really then hopefully help us to leverage those insurance savings that we're able to negotiate on to help improve affordability on those mortgage applications. So those are the three objectives which I want us to walk away with. We will recap them. And as I said, those are the things which we're able to walk away with in order to record our structured CPD. So how are we going to get there? I hear you all ask. So three key areas which we're going to be exploring. First thing is just so that we understand and everybody's on a level playing field. What is the market cycle all about? What is it? Why does it work the way that it does? Um, and what things kind of influence whether we're in a hard or whether we're in a soft market. And I've also got a little bit of history for you as well in terms of the triggers which can help us understand and almost predict really a little bit what's coming to then recognize, right, what does that actually mean for the insurance industry generally? Second thing, second agenda point is moving on to understanding how underwriters are being selective and how are they making those data-driven decisions? What is it that they are looking at? And then finally, we'll have a look at optimizing for negotiations. How can we stand apart from the competition? How can we really use that risk information to help us go to an underwriter and get them to look at things more favorably, I guess. And then as we'll move on to our summary and Q&A. So, very first topic which we're going to be looking at, the market cycle. All right. Now, I've got a nice little visual for you. And I'll just kind of talk around each of the points. And you can see that on the top there, we have the hard market. And then on the bottom, we have the soft market. You'll be able to see in brackets, hard market expensive, soft market cheap. Now, that's something which we are seeing change ever so slightly. So I want to describe what is actually meant by it, because when we explore what actually it means and what we then start to see within the market, it will really help us recognize the reasons as to why insurers sometimes are making difficult decisions, why they're not being as flexible as what we want them to be, or whether they are putting various terms and conditions on their policy to which we're not used to seeing. So let's concentrate on that expensive, that hard market. And I want to start there because it's not only there at the top, but we're very likely to be, well, the most recent hard market has been around since about 2019, 2020. Um, you're probably maybe already thinking, oh, COVID. It's not exclusively to COVID. That's the reason why that hard market tipped over. What we'll tend to find within the reasons as to why the hard market tips is usually an accumulation of things. All right. So that hard market is a period where those insurance premiums are quite high. Insurance premiums increase. Insurers also reduce the amount of risk which they're willing to take on. It's known as their capacity. Terms and conditions attached to those policies also become quite restrictive because what underwriters are then doing is being more selective on the risks which they will insure. Policy wordings will also become tighter, so you'll see variations of policy wordings being updated from insurers. Claims are also being deeply scrutinized within that hard market as well, really looking at what does this wording actually mean? Which, as a result of that, buyers and, of course, brokers working on their behalf have less room to negotiate. It's known as a seller's market because the power is ultimately with the insurer. But of course, that can only happen for so long, right? Those increased premiums, those tighter policy wordings, more scrutiny on those claims, it can only happen for a period of time. There are other things which are affected, which we'll get onto later on. But in terms of the effects and the insurer behaviors within the hard market means that they need more funds ultimately. If we understand how insurance generally works, contribution of many pays for the loss of the few, right? So what insurers then do is when they collect all of these premiums and higher premiums as well in the hard market, um, they're restricting their terms, they are scrutinizing these claims, they are tightening up their policy wordings. So they're collecting bigger premiums and not paying out as much. So it's ultimately a way of controlling what comes in and what comes out, ultimately. And the more care that they take, uh, they they sort of look at risk management in far more detail. They may even pay for or they may even force policyholders to pay for smaller losses themselves, kind of like self-insuring, really. And the reason that is because insurers will put higher excesses on or deductibles, which means that smaller losses don't meet that threshold. So yeah, they'll get a little back from the insurer on what to claim. So people kind of see it as well, there's no point really. It causes people to think twice about claiming. What does that mean for my insurance premium in the future? And the insured won't want to look at that because they don't want to claim because they don't want their premiums to increase, and are far more likely to use it in the event of something catastrophic or a complete disaster. Now, of course, all of that drives the soft market. That is one where, as we sort of move around the circle there, we'll be able to see premiums fall because insurers are going, well, we don't need all of this money anymore. It's quite a well, from a buyer's perspective, and I guess from a broker's perspective, working on the client's behalf, to some extent, and I'll come on to that in a minute. It's a nice place to be, right? Premiums are cheaper. What we'll also see is new entrants into the market. There are more in this soft market. There are more MGAs, which is a managing general agent, which effectively does the underwriting on behalf of the insurer. They don't provide the capital, the insurer provides the capital, but that MGA sort of does the underwriting and claims to depending on their terms of business, and their authority. More MGAs are coming because it's more cost effective to do that because the MGA is going, right, well, I'm going to earn a commission, and I'm going to take some form of cut from this, and then pass it on to the broker, and you get the distribution chain. Um, but it's more effective for an MGA to do that. Likewise, it's more effective sometimes, not in every case, but sometimes for an insurer to do that because they don't have the underwriting expenses. They just simply say, well, it's far cheaper for us to just take a little bit of a split in our commission for the MGA to do it. Let the MGA deal with wages and offices and national insurance contributions and so on and so forth, training, learning and development and everything else that goes with employment, really. So we're starting to see a lot more MGAs on the market, particularly with going into sort of like the Lloyd's and the London market, especially in those niche areas. So the realities of a soft market. So it seems like a nice place to be, of course, and that is the case in many respects. It's more cost effective for the client. Insurers start to add more value added propositions to their products. in order to try and stand out from the competition. Because of the sort of the increase in the capital that has come in, more MGAs and more insurers are being sort of set up, if you will, which means that then the market is kind of not flooded per se, but there's a lot more selectiveness, I guess, on where people can actually buy their products from and buy their insurance contracts. What we'll also see as well is changes in the amount of products which are being sold by a particular underwriter. So an underwriter may say, well, we want to, or an insurer, we want to tap into this particular area now in this line of business because we see it to be really profitable. And we've got loads of data, we've got loads of statistics behind us to sort of give us that little bit of confidence, and therefore we then need to get it marketed out. But likewise, on the flip side, in the hard market, what insurers can then do is the reverse of that. Then go, right, do you know what? That we're really losing. Our loss ratio is quite large on that. So we'll take it from the market. And we don't want to sell it anymore. And we've seen that within the market, like for example, LV selling their commercial book to Allianz. They don't want to deal with commercial anymore. Um, there is profitability there, so we'll give it to Allianz. They're far more what's the word? Equipped maybe to deal with this kind of stuff rather than us. And that's really great because it can sometimes in a soft market, it can be really difficult to retain a client because word of mouth gets around. Maybe existing insurers are offering lower premiums. Maybe the client's knowledge of the market and the market cycle is there, which then clients are far more likely to shop around themselves, far more likely to go to another broker to ask for more quotations. Now, that can have a danger because what happens if there are lots of brokers competing ultimately for this, working against the same risk or working to place the same risk into the market? Now, the reality of it is that insurers won't quote because insurers will see that I've already quoted on this risk. Insurers are not going to compete, number one, against themselves. How can they? There will also be some sort of within TOBAs, almost like a client ownership or a non-solicitation clause within their terms of business, which effectively is kind of similar to a non-compete type thing, which means that it's kind of on a first come, first serve basis. So the first broker that gets in there, when they disperse it into the market, what the danger which we have is that it blocks the market. So I guess from a broker's perspective, that's a good thing, I suppose, because it will help with our client retention. But at the same time, if that client is also going to a broker or maybe even a sub-broker doing it on their behalf, and the sub-broker then going to another broker, generally speaking, there are only so many markets and there are only so many insurers which will actually quote for this risk. So it's a danger, but it is a tactic which brokers use to try and help retain their client at renewal. But from a soft market perspective and trying to attract and trying to get and obtain new business, it's hard, it's dangerous, and not good for the client ultimately because the insurers are just saying, well, I've seen this, let's move on. So, what causes these market cycles? So, first thing, of course, supply and demand. The good old concept of lots of supply, the demand is probably going to be continuous, but people moving from a soft market to a hard market, I guess the demand probably won't be there as much. The reason being is because people have been trained by the insurers to take real care of their risk management, to really understand what risks do I have, what am I not going to claim for, and so on and so forth. So people are then starting to see, well, I don't really need insurance because all of these smaller things, I'm going to take care of them myself. Which ultimately means that people are not buying these types of things, which they may even be used to buying because it was cheap. I could claim versus it's not as cheap anymore, so I need to look after my bottom line as as the client. They've got a business to run as well, of course. Um, and I can't afford it, so therefore I will take more precautions instead. So it flips, of course, when we think about it from the soft market perspective. What is there? What is the demand within the insurers? Insurers don't just collect um, insurance premiums. Insurers just don't just make money from their insurance. Excuse me, sorry. Neither. From their pool that they collect, insurers uh, invest it. They invest a certain amount from that pool of premiums that are collected before claims are actually paid. Now, the reason that insurers do this is it allows that pool of money to grow much quicker than it would by just simply sticking it into the bank. Okay. Of course, you'd think that, if we want more money, we collect more insurance premiums, and with more insurance premiums, then of course that brings more losses. So it isn't a quick fix. So those investments allow those buying insurance to benefit from those lower premiums because investment is higher. And the result of that, if we look at low periods of inflation, like we saw in COVID, then insurers aren't going to get their return to put it back into the pool. But that doesn't stop claims and losses occurring and claims that need to be paid out, which then forces insurers to drive up their premiums because their returns are not, it's all about balancing, really, isn't it? And ensuring that they've got that sufficient amount of money within their pool to pay for those predicted losses. Third thing, of course, the backbone of all insurance is the insurer's loss experience. Claims data is the heartbeat. Uh, and it's a run of accumulative large losses. Think of fires, floods, subsidence, liability claims, which could harden the market for those specific risk categories or specific lines of business, despite the wider market remaining soft. So it's not just a case of, oh, the insurance is now in a soft market. It's now moving into insurers really analyzing and getting in and going, right, PI, for example, is now in a hard market. Um, Property and casualty is in a soft market. And in fact, what's really interesting, I guess, is where insurers, as we've seen in the last hard market that we've been in, um, the PI, well, financial lines, PI, D&O type risks, they moved into a soft market um, quite a bit of time ahead than the property and casualty sector. Um, so insurers are really looking at those claims experience to then help determine what is competitive, what remains soft, what remains hard, or what we need to move into hard and what we move into soft. Insurers are just simply not discounting everything anymore. They're using this data to really help identify what they really, really want. There are inflationary pressures as well, for the reasons that we've kind of talked about from the investments, of course. Actuaries spend huge amounts of time looking at data, calculating probability of losses, disasters. Their job is very much a very sophisticated guessing game. But what happens when we have high periods of inflation? The actuary does a pretty good job of calculating their share of the market, how much they're going to be paid out, how much are they going to be paying out, I should say, to know how much premium that the underwriter needs to charge. But with inflationary periods, high inflationary periods, that doesn't necessarily mean that insurers are likely to see more claims. But what they are likely to see is when those claims come in, insurers are going to be paying out a lot more on the claims than what they would have in a previous market. So they see the risk differently now. And when insurers pay those claims, it costs them more. There are various other things as well, such as regulatory and political changes, such as Solvency II that we've seen 2016 that come in, and it gave insurers 2 years in order to make sure that they have a sufficient amount of capital so that they are 99.5% confident that they are able to meet liabilities within the next 12 months if they weren't able to capture any more insurance premiums. And of course, there are various precedents that are set by case law. I think we can kind of go back and look at various things such as asbestos-related injuries to really tip casualty cases. If a precedent is set to go, yes, you need to pay, then what can an insurer expect? They can expect a fluctuation of claims. Now, the challenge which insurers, of course, have with that is the history, because an insurer, when you buy an insurance product, of course, you pay the premium today, but because of how these claims could potentially come in, it doesn't necessarily mean that my claim is going to be paid within that period of time, does it? I could have a claim 3, 4, 5 years down the line, could even be longer. And these are known as long tail claims, which ultimately then the insurer go, right, now that's going to tip me because I'm in a soft market. I've collected smaller insurance premiums. I've collected a lot of them. A lot of policies means a lot of claims, as we've just discussed. And now something is going to trigger, right, you can't no longer do that, or you need to pay on these particular claims now. So there's an accumulation of these different things which will tip that market. Just as a little bit of a timeline for you to really sort of help understand how long these periods of hard markets are. Traditionally, we're able to see hard markets last for around about 3 years. The discrepancy is the most recent one that we've been through, 2019 to 2025, a 6 year, 5 to 6 year period, depending on who you speak to, I guess, and depending on what data that you look at and what research. But you can kind of see there really uh, things which, if we look at it from an accumulation, um, then yeah, you can see that huge amounts of losses which will tip certain things. 9/11 terrorist attacks, burst of the dot-com bubble, reinsurance availability. I'm not going to go through them all. You're far more capable at reading quickly than I am talking. So we are effectively out of that hard market, but remember, insurers are being much more selective. So why are they being more selective? Let's dive into that data-driven decision, okay? So when an underwriter looks at a risk today, they're not looking at what was paid last year, working out the percentage and the reduction that they're able to give us based on their claims experience. Yes, there is an element of it, of course, and an insurer would reduce across a particular line of business, as we just talked about. But an insurer are now interrogating the data behind that risk more than ever. They want to understand the quality of the risk now. They want to understand the quality of what is being asked to insure. Not just what, but the quality of it. Okay. And in order to help with that, they are using increasingly sophisticated tools to get that what. And now it's our job as brokers to really paint that picture on the how. Okay. So, of course, insurers heavily relied on information presented to them by brokers, by clients using proposal forms, claims histories, going visiting the client during a survey. But today, insurers are pulling data from multiple sources and they're doing it simultaneously to try and build a far richer picture of that risk before they even start to open up a conversation. They're using things like satellite imagery, aerial photography, geospatial mapping to really assess properties remotely. And the data that is then obtained from those platforms and those systems is being layered in real time, meaning that an underwriter can really build an environmental risk profile of that property within minutes without even visiting the site. Insurers are also integrating third-party data sources into their underwriting platforms, things like land registry, property transaction data, building regulations, planning histories, even things like Companies House for commercial risks, weather and catastrophe modeling data from specialist providers. As insurers then face pressures to compete on price and also speed in a soft market too, what are they doing? They are turning to AI to try and help facilitate it. It's far more quicker than a human. So when we submit risks, what it then does is to go to some form of portal, some form of platform, algorithm, AI facility, whatever it may be, and it's triaging. So no longer does an underwriter have a stack of risks which they have on their desk and sort of take them one by one on from the top to the bottom, and then go, right, let's kind of triage this. Is this something which fits our underwriting criteria? Is this something that we want? Yes, pile, no pile. The AI is doing that for them. So it's saving time, which does then help speed it up. So underwriters see the benefit of it, of course. Um, but of course, that comes with some challenges. Of course, it does as well, because what is the contextual decisioning behind it? Are insurers using platforms to connect internal and external data? How are they building this holistic profile of places, assets? How are they reviewing the overall portfolio performance? Okay. So, how are they utilizing AI to do it? Well, three key things. First thing is machine learning models. Machine learning models are trained on vast data sets of historical claims, property characteristics, environmental data, and even things like macroeconomic factors as well. So the output of that predictive risk score, then it's dynamic and it gives a data-driven assessment of the likelihood of the severity of future claims on any given risk. If we think about what an underwriter does, generally speaking, I'm not tarnishing everybody with the same brush, but love data. That's how they price the risk, which means that underwriters are no longer relying purely on their judgment or their experience any longer. What they're now doing is using AI generative um, uh, platforms in order to form a baseline of where to work from. So they're not going, right, let's look at this risk anymore. Yes, no pile. That's being done for them. So they're just looking at the yes pile now. And they're not sort of, for risks that kind of score well with it, then what insurers do is to go, right, okay, ooh, this is a nice piece of business, because ultimately they're fighting for it, right? They want to increase their market share. They want to satisfy shareholders, of course, as well. Um, so when we think about it from a perspective of those risks, then the model provides that, yeah, this is scoring really high or this is scoring really low. And the AI is able to give a rationale to either, say why I'm declining or say why I'm scoring it high. And depending on how far and sophisticated that the underwriter and the insurers have gone with investing in this type of technology, it can even go as far as applying those restrictive terms or increasing those insurance premiums for risks that it doesn't like. For those lower complexity risks, then what AI is enabling it to do is to go through a straight through process. So where those submissions are received, it is able to assess, it is able to quote, and it is able to apply terms and conditions, and it is able to price it, all without a human underwriter getting involved in any way, shape, or form. It's already happening. You may even seen it yourselves. Um, Especially across personal lines, and more increasingly towards those SME commercial risks. It's got a significant implication around it. If the risk is being assessed by an algorithm rather than a human underwriter, the data quality of that submission from the broker means everything. There's no relationship with that AI. There's no conversation that happens with that AI. There's no opportunity to explain the context behind the risk which we're submitting. The data either supports a competitive outcome or it doesn't support a competitive outcome. And that's the harsh reality of it. So it does sound quite negative so far, but I promise it isn't. Because what insurers are also now using AI to do is to read and analyze submission documents, read and analyze policy wordings, claims reports, and they can do that at scale. So underwriters are then using those tools to identify, right, where are the coverage gaps? Are there any inconsistencies? What are the risk indicators and they can do that at a fraction of the time. It allows them to be more consistent. It allows them to be more objective and to give an objective viewpoint with a rationale behind it and to make necessary recommendations to guide the client and broker working on their behalf to help manage the risk more effectively. And we know that a better risk and better risk management means that insurance premiums are lower, terms are more competitive, and of course, it sustains the market cycle for a longer time. Which I think that with all of this introduction in the technology that we're seeing, I really do believe that, I mean, historically, if we kind of have a look, um, the soft market probably lasts for around about 10 years or so. Um, I think with insurers now being able to be more selective around it, can that last for a longer period of time? Don't get me wrong, there will be another hard market. We can't get away from it. Because of the natural cycle. And in short, let's be fair, insurers do chase that shorter term. There are some exceptions to the rule. You usually when I say insurers chase that shorter term thing, it's usually to satisfy policyholders and to gain more market share, right? There's no denying that. But where we look at insurers which may be set up in a mutual way, for example, NFU Mutual, for one example, there are others, of course, um, you don't have to satisfy shareholders. What you have to satisfy is the policyholder. So I think that the sort of captive and composite insurance market um, and proprietary firms where they have shareholders, I think that they will eventually become a lot more aligned with how a mutual works. And what I mean by that is if you just kind of have I'm not sure where I am on your screen, but if you just kind of have a think about how that market cycle works. So hard market, high insurance premiums, high terms and conditions, that can only happen for so long. We will then dip into a soft market. And it's quite drastic in how that curve works. With a mutual, it's not as drastic. It still happens, but it's not as drastic. So can I see those composite insurers moving towards more of a more of that way? Absolutely, I can. Yeah. So with those straightforward processing, yeah, as we kind of talked about, and that AI as the advisor. So what can we do? So if we think about this logically, if we think about the general risk information that we obtain from the policyholder, the insurer and their AI systems and their algorithms behind it, before it actually meets an underwriter, the scoring is done already. Insurers probably know a lot more about that property than we do, than the policyholder or the client themselves do. That's the reality. So, what can we do instead? So, we can present the risk a lot more favorably. And this is the kind of key takeaway which I want us uh, to move from the session. Because insurers are being selective in today's soft market, and they're doing so because their technology allows them to give them that confidence much faster, much more accurately. They're not guessing anymore. They're using data to make those decisions. So that frees up certain things for us and certain things for the underwriter. So the first thing, how do we present the risk more favorably? The opportunity is there for us to present a risk which is rich. And what I mean by rich is accurate, well-structured data, property surveys, valuation reports, loss prevention investments, environmental assessments. It's all a language which modern underwriters will now understand and will be a lot more interested in, rather than property was constructed in this year, this is the construction method of it, uh, here's the rebuild cost, this is what the windows are made out of. You get the idea, right? It's kind of a little bit redundant now, to some extent. We've got so much more of an opportunity to structure that data well now because that's what we need to do. If we structure it well, it's going to score well on their when it hits their AI or when it hits their algorithm. So the responsibility that we have as brokers is to present that risk in terms that an underwriter will want to see the risk for what it is. And we've got a duty to present it in a much more favorable light. The end of the day, we want the underwriter to compete for the business because it's them, we want to go, right, I've got a risk. Think of it as going to market. It sounds really silly, but it's true. If we've got a risk, who wants it? Because that's the kind of job that we have, right? So if we present things poorly, the data doesn't stack up, or it doesn't quite make sense, then we're not going to benefit from soft market conditions in the same way. In the same way that technology rewards quality data, equally, it penalizes the absence of it. Okay. So, things that we can think about when obtaining that risk information from a client. Okay. And some things which, depending on what your authority is with Protect Commercial, I know some of you have full authority, some of you maybe introducer, but regardless of, these are the things which Protect Commercial will really help Protect Commercial present these risks to the underwriter. Okay. As I said, we all know what that data is, right? But what we're really, really keen, or what underwriters are really, really keen to understand is things like property maintenance and records of it. Probably the most impactful thing that a property owner can do, specifically property owners, not exclusively, but um, because it's ultimately within their control, isn't, and nearly entirely in their control as well. Underwriters are able to see the geography of the land it sits on, but what they can't tell is whether the gutters have been cleaned last autumn, whether the roof was inspected after the last significant storm that was suffered, whether there's a planned maintenance program in place, and what does that actually look like. The algorithm and the AI data can't see that, can they? So we need it. We can beat it. Okay. Things to recommend to a client. Keep logs. Keep property maintenance logs. It doesn't have to be War and Peace. Simple records of the date of the inspection and of the fabric of the building will be sufficient. Older properties, maybe think about considering a condition survey conducted by a qualified surveyor. Document any capital improvements that have been made, new roofs, updates to drainage, rewiring that may have happened for electrical systems and circuits. Has any pipe work been replaced? And maybe even go that step further and think about implementing a planned preventative maintenance program, because that will really show the underwriter, are you proactive or are you reactive? Proactivity really shows that the policyholder takes things seriously. Risk management and governance. One of the first things that an underwriter will want to understand in today's modern world is how serious does the client take their risk management? Okay. Again, something that an AI algorithm can't necessarily tell. Think about that documentation. But what does the policyholder do in order to identify? How do they assess? How do they try and mitigate risks across their properties or portfolio? Do they conduct regular reviews, regular visits? What actions do they take? When was the last time that they engaged with a surveyor? And finally, claims and loss management. Now, I know that, of course, that's the job of the insurer to pay the claim. And yes, they will have raw data to show the number of claims, the amount paid, the date. But what we can do to really add the narrative and the flavor behind it is understanding what happened, why did it happen, what changes have been made to try and control or try and mitigate that risk moving forward. What evidence do we have of any remedial actions following that loss? For example, if they've suffered a flood, have they now installed flood barriers? Have they improved drainage? And again, guess what is key? Documentation. Okay. And of course, is there an appetite to avoid the instinct to make those smaller claims? Because again, our jobs, I believe, is to educate the client to go, if you accumulate all of these smaller claims, because I get it, right? I seen a video on social media the other day, and it was someone saying insurance is a con or insurance is a scam. You've probably heard that. I know I definitely have. And actually, I think it was really bad advice. And I think it can be quite dangerous. And they were saying, you pay all of this money into a pot, you never get anything back from it. Make those claims. Yeah. It's information and like that, which will influence people to go, do you know what? Yeah, I actually have had a small claim. I'll make that smaller claim. Sorry, a small loss. I'll make that smaller claim. But an accumulation of that, guess what it's going to do? Shrink the pool, larger reinsurance premiums. You get the idea. So insurance should really only be used for disasters, you know. Those smaller type claims really should be handling them themselves because what we have to remember, and again, what we have to educate our clients sometimes, is that insurance is not risk management itself. Insurance is a risk transfer mechanism. So let's have a summary because I appreciate your time. So hopefully we should now be able to define the soft market, what it actually means, identify why insurers are now being selective based on the data that they have, understand what can be used to try and help negotiate on insurance terms, and to hopefully leverage those insurance savings to help improve affordability on the mortgage applications that come across your desk. So, again, I'm appreciate and conscious of the time, but if you do have any questions, we haven't had any come in, please pop them into the Q&A. I'm more than happy to answer them. If not, then thank you ever so much for your time, for your attention. I hope that you've enjoyed the session. I hope that it's giving you a flavor as to what is going on in the market at the minute. And we'll give you some food for thought on how we can maybe get ahead of the curve and how can we be part of the solution. Um, to really help support our clients and to support the industry as a whole, really. So from me, thank you ever so much. I will get the recording distributed. This is structured CPD. So of course it's a webinar with learning objectives. Please ensure that you do record your CPD on whatever LMS system that you use. A copy of the recording and the learning objectives will be issued to you by your account manager at Protect Commercial so that you're able to then have the evidence for your CPD as well. So no Q&A have come in, so I am going to close and end the webinar. So from me, thank you ever so much. Thanks for having me. Enjoy the rest of your day and enjoy the rest of your week, and I will see you on the next webinar. We'll be publishing what that webinar is. So again, if of your interest, please register. We hope that they are useful for you. The feedback that we had on the first one has been. Again, we'll be sending another feedback because we want to ensure that they are worth your while. You know, you're giving up your valuable time, to which I've taken an extra 5 minutes of it. So, thank you, everybody. Take care and enjoy the rest of your day.